Are you paying way more taxes on your short-term rental than you should be? What are the expenses you already paid for, like furniture, appliances, upgrades, and even like the wall, the flooring, the electricals, can actually come your biggest tax advantage? So in today's video, we're breaking down one of the most powerful and most misunderstood tax strategies for Airbnb hosts and for short-term rental investors. Today, we're going to elaborate on cost segregation. So if you ever wondered how experienced investors or how the rich people legally reduce their tax bills while scaling your portfolio, this video is for you. So we're going to cover what cost segregation actually is, why it works especially well for short-term rentals, and how you can use this structure to improve your cash flow, reinvest faster, and grow strategically. Let's get into it. If you're making more than $500K yearly, you may already fall into the tax trap. No. Where most high earners don't even realize exists. The more you earn, the higher your tax rate. The harder you work, the larger percentage that disappears. So the problem here isn't that you don't make enough money. The problem is that almost all of your income is active income. And you know what? Active income, ordinary income gets taxed the hardest. All we do is simple. For just $100 to a few $1,000s, we help you transform real estate from a rental property investment into a strategic tax structure that can legally offset your W-2 income through STR qualification, the 100-hour rule, cost segregation, and meticulous time logs. We help you to redesign your tax identity. So think about how much tax you can save behind this. In many cases, up to 30% or more of your property's value will be reclassified for accelerated depreciation, where we also called bonus depreciation, where we turn your real estate investment into one of the most powerful weapons against high marginal tax rates. So if you're making over $500K a year, you don't need to work harder. You just need to reposition. Book a call with us now and let us know how we can help. So on the first part, let's talk about what cost segregation actually means. So most residential rental properties are depreciated over 27 and a half years, right? That means if you buy a property today, you're going to slowly deduct the cost over nearly 3 decades. But here's the problem. Not every part of the property actually lasts 27 and a half years. A cost segregation study breaks your property into components that wear out faster. And then the report will reclassify them into shorter depreciation categories like 5 years, 7 years, and 15 years, including like your flooring, like the carpet, like all the appliances, etc. So instead of waiting out for almost 3 decades to recover your cost, you can accelerate those deductions into early years. That means you can deduct up to 30% of the housing price when you purchase as a rental property. So how the process works, it actually looks like this. Step 1 is documentation review. You need to keep all purchase records, renovation invoices, and asset lists. And step 2 is to hire a cost segregation engineering team. Ask them to do an engineering-based evaluation. So specialists will virtually or on-site evaluate the building systems, the finishes, the fixtures, your backyard, your lawn, and all the improvements, and then decide how much this rental property can actually help you to reduce tax. And step 3 is what we call depreciation reclassification. So your tax professionals, meaning our team, will apply our as defined asset categories and create a revised depreciation schedule. So this is where the tax code really benefit the high W-2 earners and rental property investors, because this can guarantee you a customized depreciation roadmap that front loads your tax savings, which can save you like 6 digits of tax every year. You might have long-term residential rentals right now, but in this chapter, we're going to talk about why short-term rental benefits more than long-term. So short-term rental are uniquely positioned for cost segregation. Why? Because the STR, that stands for short-term rental owners, typically invest heavily in the furniture, appliances, decorative finishes, and remember, those are not just for aesthetics. All those improvements are depreciable assets. So As long as you invest in 100 hours per year to qualify this STR rental, the cost segregation can actually help you to unlock cash sooner. So you can reinvest this money that you save without waiting years to recover your capital. And then, of course, with the money that you save, you can put all these cash into a high volatility market and to keep your equity competitive. So here comes a real example of a case study. So imagine our client, Sarah, purchased a vacation rental for $600,000 in a ski town. And then so within those investments, there are $30K of appliances, $20,000 of custom fixtures, and $50,000 of other furnishings. So in her case, instead of depreciating everything over 27.5 years, a cost segregation study reclassifies these assets, so her annual depreciation increases significantly, results in tens of thousands of tax credits per year. So the cost segregation really is about keeping more money of how much you make, and then you can reach an accelerating growth of your income through other investment. So you can save these taxes and put the cash into a better use. So now we come to the most important part. What actually qualifies you for bonus depreciation, or what we call accelerated depreciation? So when we talk about cost segregation, we are actually breaking a property into components that depreciate at different speeds. The first one is like personal properties, including furniture, appliances, electronics, decorations. The second improvement is land improvement, including, walkways, driveways, landscaping, fencing, etc. And the third one is called certain building systems, like big appliances like HVAC, like electrical systems, plumbing systems, and all of these components can be broken down. So if you decide to do the cost segregation, here's the critical part. You have to be done correctly. Any misclassification can create compliance issues, and that's not what we want to do here. So cost segregation is very powerful, but it needs to be structured and also be engineered properly and documented by the lenders properly. So what my team does is to walk through how you can qualify. So the STR lenders qualify you for the material participation, and then used all these big and small bonus depreciation to offset your W-2 income. So at least you need to expect yourself to dedicate more time, and this is not just simply a DIY spreadsheet strategy. So we talked about this strategy only works when the timing is right and you're trying to do everything correctly. And then this tool can be extremely powerful. So it tends to be most powerful if you recently purchased property, complete some major renovations or whatnot. And if you're in a higher tax bracket and own multiple short or long-term rentals, and you're actually actively managing your short-term rental activities. But here's the part that trips a lot of people. So in order to qualify this deduction, you actually have to materially participate into the short-term rental activities. And then your rental losses, no matter if it's short-term rental or long-term rental, will not be considered passive. And that changes everything, because as we know, when we structure it properly, cost segregation does not just reduce your rental passive income, it also offset active income, including your higher earner W-2 income. And that's the point where strategy meets scale. So this is exactly what we called the real estate stops just being an asset that makes you cash flow and start to become a structured tax vehicle for you. So our goal here is simply to stacking strategies for maximum efficiency. So when you're able to combine all these deductions with accelerated depreciation and proper STR qualification, you're not just cleaning deductions, you're building yourself a tax-optimized operating system. So our team and our aim is to let this rental property become business asset designed to optimize the cash flow, improve return on investment, and creating reinvestment opportunities. So what our team can help you to tackle with is about your qualification, how to structure, and how to use your current asset. We help you go through the compliances, and we help you to do repositioning to make sure all these assets can become your tax saving vehicles. Book a call with us in below link, and I'll talk to you next time.